Saving money on mortgages and loans doesn't have to be complicated. Most people tend to accept the first offer they get. But if you know what to look for and how to compare options, you can save thousands of dollars or euros over the life of a loan. The first thing to understand is interest rates. Mortgages and loans come with either fixed or variable interest rates. A fixed rate means your interest stays the same throughout the term, which gives stability and predictability. A variable rate can change over time, often starting lower than a fixed rate, but it can increase, which makes budgeting harder. Understanding the difference is crucial before signing any agreement. Another important factor is the loan term. Shorter terms, like 10 or 15 years, usually come with higher monthly payments, but you pay far less in interest over the life of the loan. Longer terms, like 20 or 30 years, reduce monthly payments, but can cost much more in interest. You have to balance what fits your budget with what will save you money in the long run. It's also vital to compare offers from different lenders. Don't just go with your bank. There are many banks, credit unions, and online lenders that may offer better rates or lower fees. Small differences in interest rates can add up to huge savings over time. Always request a detailed breakdown of all fees and charges before committing. One often overlooked tip is to improve your credit score before applying. Lenders offer the best rates to people with good or excellent credit. Paying down debt, making payments on time, and checking your credit report for errors can help you qualify for lower rates. Even a small improvement in your credit score can save you thousands over the life of a mortgage or loan. Another strategy is to make extra payments whenever possible. Paying a little more each month, even if it's just a small amount, can significantly reduce the total interest you pay. Some loans allow you to make lump sum payments without penalties. It's always worth checking if your mortgage or loan offers this flexibility. You should also consider refinancing if interest rates drop. Refinancing means replacing your current loan with a new one at a lower rate. This can reduce monthly payments or shorten the loan term, saving you money in the long run. However, refinancing usually comes with fees, so you need to calculate whether the savings outweigh the costs. Many people forget to factor in additional costs like insurance, property taxes, or maintenance when planning for a mortgage. These can add significantly to your monthly expenses. Budgeting for all costs up front helps prevent surprises and keeps your finances on track. It's also smart to avoid unnecessary fees. Some loans come with origination fees, early repayment penalties, or hidden service charges. Always read the fine print and ask your lender to explain anything you don't understand. Avoiding or negotiating these fees can save you hundreds or even thousands over time. For personal loans, it's often better to borrow only what you need. Taking on more debt than necessary increases interest costs and can strain your budget. Focus on loans that serve a specific purpose and have terms you can comfortably manage. Another tip is to set up automatic payments. Most lenders offer a small discount or benefit for automatic payments. Even if they don't, automating payments ensures you never miss a due date, avoiding late fees and protecting your credit score. It's also important to review your loans regularly. Interest rates and market conditions change, and new products may become available that are better suited to your situation. Being proactive about your loans can lead to better financial outcomes. Finally, remember that patience and planning are key. Saving money on mortgages and loans is not just about finding the lowest rate. It's about understanding your options, making informed decisions, and being consistent with payments. Over time, these strategies compound into significant savings. By understanding interest rates, improving your credit score, comparing lenders, making extra payments, and avoiding unnecessary fees, you can take control of your loans and mortgages. Smart decisions today can save you thousands of dollars or euros in the future, giving you more financial freedom and peace of mind. Another very effective way to save money is to make a larger down payment when buying a home. The more you pay up front, the less you need to borrow, which reduces both your monthly payments and the total interest over time. For example, putting 20% down instead of 10% can save you thousands over the life of the mortgage. Even a slightly higher down payment can make a big difference, so it's worth planning ahead and saving before applying for a mortgage. You can also consider bi-weekly payments instead of monthly payments. Instead of paying once a month, you pay half of your monthly mortgage every 2 weeks. This results in 26 half payments, which is the equivalent of 13 full payments per year. That extra payment goes directly toward the principal, which reduces the interest you pay and shortens the loan term without making a huge difference to your monthly budget. For those with variable interest rate loans, it's important to monitor market trends. Variable rates may start low, but they can increase over time. Keeping an eye on interest rates allows you to refinance or switch to a fixed rate when it's beneficial. Even small changes in interest can have a big impact on the total cost of your loan over decades. Another smart strategy is to bundle financial products. Some banks offer lower interest rates or reduced fees if you have multiple accounts with them, like a checking account, savings account, or credit card. While this doesn't work for everyone, sometimes combining products can save money or provide additional perks, such as fee waivers or cash bonuses. You should also think about loan insurance carefully. Some lenders offer mortgage insurance or loan protection plans. While these may add extra cost, they can provide peace of mind in case of unexpected events. Evaluate carefully whether the benefits are worth the extra expense and shop around for competitive rates. Paying attention to timing can also save money. For instance, applying for a mortgage at the right time of year, when lenders are promoting lower rates, can make a difference. Similarly, refinancing when interest rates drop significantly can save thousands. Timing, research, and patience all pay off when dealing with loans. Another key tip is to avoid unnecessary extra debt while paying off your mortgage or loans. Taking on new loans or high-interest credit cards can reduce your ability to pay off your main loan efficiently. Focus on eliminating expensive debt first, and make sure your repayment strategy is consistent and sustainable. It's also helpful to use online calculators and comparison tools. Many websites allow you to compare multiple mortgage offers, calculate monthly payments, and see how much interest you would pay under different scenarios. These tools make it easier to make informed decisions and avoid mistakes. For people with multiple loans, consider loan consolidation. If you have several high-interest loans, consolidating them into a single loan with a lower interest rate can simplify payments and reduce overall costs. Just make sure you understand any fees involved in consolidation so the benefits outweigh the costs. Another often overlooked tip is to review your mortgage or loan documents carefully. Sometimes there are clauses, fees, or conditions that could cost you money if you're not aware. Asking your lender to explain everything and checking for prepayment penalties or hidden fees is essential. Understanding the fine print can prevent costly surprises. You can also explore government programs and incentives. Many countries offer programs for first-time homebuyers, energy-efficient home improvements, or refinancing assistance. These programs can reduce your monthly payments, lower your interest rate, or even provide tax benefits. Checking eligibility for such programs is a smart move. Finally, consider long-term financial planning. Your mortgage or loan should fit into a broader plan for savings, investments, and retirement. Making small adjustments now, like paying a little extra toward your principal or avoiding unnecessary fees, can have a big impact on your financial future. The key takeaway is that saving money on mortgages and loans is about knowledge, planning, and consistency. Small actions, like paying a bit extra each month, refinancing at the right time, or choosing the right interest rate, can add up to tens of thousands of dollars in savings over the life of a loan. By taking control of your financial decisions, comparing offers, understanding interest rates, and managing your payments smartly, you can reduce stress, save money, and achieve your financial goals faster.